What's up, everybody? Welcome to the Life Cycle of a Trade, the series where we break down the thought process behind the trade entry, trade management, and the closing order. In this video, we are going to cover a short put spread. All right, so getting another trade on the board here. So one stock that has been absolutely hammered over the last couple sessions here is CrowdStrike. You obviously had the big news on some of the issues with their software update. I don't think it was a hack, but it was a big problem, obviously, and the stock has sold off significantly. I think this is an opportunity to play into some of the volatility. Of course, when you have this big move, volatility tends to expand, and volatility is an expression of the expected price movement in the underlying. Given that we've had such a big move, I think this is a little inflated moving forward. So I'm going to look and sell a put spread in September in CrowdStrike. So we typically like to sell somewhere around a 20-ish delta. I'm going to look at this 230 mark. It's right around the lows here of arguably the whole year. So if you go back to the beginning of 2024, it was trading somewhere in the 250, 240-ish range. I think that's probably our bottom here. So I'm going to look at the 230 strike. Again, I'm going to go about $10 wide here. So I like to put on about $700 to $800 in total risk when I'm using my positions in this portfolio. So I'm going to look to sell this $10 wide spread. You can see it's got about a 70% probability of success. That's because we're selling roughly a 20 delta short option, and it trades at a little less than 1/3 the width of strikes, which is what we target when we are selling a spread here. So we're going to route this here at 223, see if we get filled. No fill there, even into the down move, which should help with our fills here. We'll move this down to 220. No fill there. Markets are a little wide. This is a volatile stock, high price stock, so it's not uncommon to have to adjust some of these spreads here. There we go. We got filled at 215 as we were adjusting the prices. Stock down ticked a little bit, which helped because we are getting long delta here. So we are getting bailed out today, and the last couple weeks with this price action in CrowdStrike, we've got the E-mini S&P 500 futures up 50 points. They've had a V-bottom bounce back rally here. We sold this put spread in CrowdStrike, which has been all over the news for the problems that they had with their update and all sorts of bad stuff going on here. We tried to catch a falling knife, and unfortunately, when we put this position on, the stock was trading at 269. It got as low as 200 over the last 2 weeks or so. So we put this trade on the 24th here. It seemed like it was going to be a bottom spot here. It's rallied all the way back to that point. We went from 264 all the way down to 200, back to 262 here. Getting bailed out on this put spread that is now right at them, or a little bit out of the money, I should say, but is right at a scratch or so from when we put this position on. Now, you still have very high implied volatility, and we're kind of getting bailed out on this price action. So for me, I'm looking to turn this position into a more neutral position. I'm still going to stay in it. Volatility is still very, very high. We got an out-of-the-money position, so I'm comfortable holding that risk. But I think given the price action, it's time to put a little bit of a hedge on it in terms of some short delta and some short premium to take advantage of some of that volatility. So you can see we've got about a 20-ish short delta put and a 16 delta long put. I'm going to do somewhere around the same thing on the upside. So that would put us at like the 310, 320 call spread. When we look at that on the chart here, that puts us at risk somewhere above this big gap, right? So I'm okay with taking risk there. I would expect to see a little bit of a vol contraction if that does happen too. So, and a passage of time, because that's not going to happen this afternoon. At least I don't think it's going to. So I'm going to look to sell this at about $1.40. This will put us at a net $3.50 or 60-cent credit here, which is 1/3 the width of the strikes. It's exactly what we look for on entry with an iron condor, but I'm really just trying to take advantage of this huge move that we've had in CrowdStrike. So let's see if we can get filled above the mid price here. We'll put it at 140, which is a little bit above the mid price here, and work our order from there. So no fill at 140. We'll put this down to 138. I'm going to try and get a penny above the mid. There we go. So we sold this at 138. So we've now got a total credit of 353 on this position. It's currently marked at 337, 340-ish. So I'm up 10, 15 cents on the trade, net. Nothing really huge, but just trying to make an adjustment to this position, turn it into a more neutral delta position, and capture some of that high implied volatility that we're seeing. Things are working out for our CrowdStrike position. So we've stayed kind of range bound in this range. So we actually haven't made or lost anything on this call spread, but it did provide us a little bit of protection if the stock did come down a little bit further. So the iron condor, as it stands now, is currently marked at about a $73 profit. Now, it's a little bit less than what I would typically target. I typically look to get about $100 out of a $3 Y or a $3 credit position. $3.53 is my net credit on this whole position. But I did sell the original put spread at $2. So, 75 cents or so would be about, 1/3 of that, about 30% of the max profit from the original position. But the stock does have earnings coming up. So you can see earnings are on the 28th, which is the middle of this week. The stock, obviously very volatile. It has moved significantly in both directions. I think rather than holding it through a binary event like earnings, I'd rather just take the money and run. So I'm going to take the money and run and see if we can get filled on a position here or a closing order here for a couple bucks. So when we're closing out of the positions, you right click on the ask price for your short option. So you're buying to close, you're selling to close on the long option, which is on the bid. Same thing on the upside. We're buying to close the short, selling to close the long option here. From our order chains, you can see we're making a couple bucks on this little bit of a move lower here on the call spread. But altogether, it should be somewhere around a 70-cent profit. Let's see if we can get filled at exactly 70 cents, which would be a 283 debit, which would put us at a $70 profit. No fill there. We'll go cancel and replace. Move this up to 285. And there's our fill. So we got filled at 285 on this iron condor. You can see once you route the trades together, they were in two separate chains. The chains come together. It's on the tastylive platform. It's a great feature. So it chains both those orders together because we closed them together. You can see I made $68 on this. I sold the original put spread at $2.15, sold the call spread at $1.38, and closed it out today $2.85 debit for a $68 profit. Nice little trade. Avoiding earnings was the key to this one. Comment below on what strategy you'd like me to cover next. If you want to catch these trades live, tune in to Johnny Trades every Wednesday at 9:40 a.m. on Tasty Live. Peace.